Hi all, and welcome back to another episode of the ICIS Energy Foresight podcast. It's a special episode because it's the first episode of 2026, and there's a special guest with us, Laurent Nery. Thanks again for coming back on our podcast, Laurent.
Thanks, Matteo. Nice to be there.
And we closed 2024 together, looking at what could happen in 2025, and it's an honor to have you back on our podcast to look at what might happen in 2026. I know, and we were just chatting about that. We're recording this at the end of January. It feels like the whole year is already behind us. A lot is happening. But yeah, I'm looking forward to have this conversation with you. We're going through different places and trying to understand what's going to happen on the energy market. And the starting point is kind of obliged, if you want. A must go point, which is geopolitics. So geopolitics is clearly in the driving seat. We've started the year with a few big announcements, a massive military operation in Venezuela, which obviously took the whole oil market a little bit by surprise. I know that it's always a crystal ball exercise, but what is your view, Laurent, on what how is geopolitics driving the energy market, and what can we expect?
Okay, yeah. So for the geopolitical event that we went through since the beginning of the year, actually, if you take a step back, even last year there was quite some surprise developments in the war between Iran and Israel, and oil prices did not move that much compared to the risk of having a blockade of the Hormuz Strait. So as we speak, oil prices are back to $70 per barrel. We don't know what will happen this weekend. It's always difficult because we know as well that the U.S. administration is not willing to have high oil prices. You have the midterms at the end of the year, and for a lot of people looking at the gasoline price when they go to the pump station, it's quite of a big risk to take. So. And on the other hand, one of the surprises of last year was the OPEC that are increasing their production. So I would be tempted to say that the supply and demand forces on oil market are still relatively bearish and rather a good supply, demand which is a bit weak, even though we know that China is stockpiling quite a lot of crude. But obviously, if a war starts and suddenly we start not to control what is happening in some key areas of the world, not only on oil but on gas and LNG markets, any impact on the Hormuz Strait will be great. Then if you go on the next step, you cannot imagine this part of the world being blocked too long, so there will be a military intervention. And then we have all this superpower, China, Russia, US, with a lot at stakes when it comes to hydrocarbons that indeed are, let's say, maybe preparing a new energy order. Still very complex to price those risks. Europe is getting rid of Russian gas, so the main view on the market, it will not have a big impact because current Russian volumes are quite low and compared to what they were 4 or 5 years ago. And for the LNG, they can go in Asia, and we can replace Russian LNG by US one or other origins. But of course, we are entering a new era. When it comes to the gas markets, the new LNG bubble, which started to materialize in 2025, will be even bigger this year, even if we will have delays. So at the end of of your question, it's still a bit complex to see how the geopolitical can disrupt the supply and demand balances and forces, but there is strong views, I think, that for oil and gas demand is quite sluggish, while supply is there, unless something happens.
I completely agree, and you've touched upon a couple of key points there, Laurent, that I wanted to ask you. So these, if we take oil on the side, which is obviously has got quite a lot of implications across many industries, even if you want also to the whole economy to a certain extent. There is an element of the new energy order, which is specifically linked to gas and LNG, which is quite interesting in the way it's. It might be a market shift, a total market shift, obviously, with the new wave of LNG projects that is coming online. We entered the winter year in Europe with gas prices below 30, with a lot of expectations, bearishness, if you want, all around. We are at the end of January. Temperatures have been relatively low, but yeah, if you want like a normal winter, but definitely colder than previous one, and we're now experiencing quite a few rallies in terms of the gas price dynamic. What do you expect for 2026? There's on one side is a lot of LNG that is supposed to come. On the other side, you see that the market is still very open to a lot of disruptions. Is this just a new reality that we need to live with, or is just the beginning of something that might change towards the end of 2026?
Yeah, it's super interesting because indeed, if we had made the interview in December, we would have talked about this bearishness that was driven by a lot of the LNG that were coming. But what is interesting is that the fundamentals of the European market, we know that we started with quite low gas in store compared to the previous years, especially because Europe started to stop importing gas from Russia through Ukraine, beginning of 2025. And when you start with less flexibility in the system, and when you rely on LNG markets, which are interconnected, depend on what happens in Asia, in South America. Indeed, we actually use quite a lot of gas in store at the end of December, when suddenly we started to have, let's say, more winter condition in Europe. And what happened over the past weeks is that it was even cold in Northeast Asia, the US, and Europe at the same time. And then indeed you realize that the margin that you've got in your storages is not that big. But it's very interesting, this disconnection that appeared on the market, that it's really the front months, the front maturity that priced the potential risk until the end of the winter, while the curve, so next year, Cal 27, Cal 28 on TTF, prices are, let's say, very reasonable, around 26, 27 euros per megawatt hour, which really reflects a bit this sentiment that, okay, storages in Europe are likely to be probably below 30% at the end of March. If they are below 25 or 20%, indeed, here you enter a bit the danger zone of having spikes, because you can have late cold spell, and when your storages are low, you have less withdrawal capacity. So I get that markets are participant and trying to price those extreme events. But when you make your summer balance, you know that you have a lot of LNG that should come on the market. Year on year, we are talking probably about 50 BCM more. So last year, worldwide, it was close to 25 BCM, and this year we double. And indeed, you can have some delays, maybe in some projects, maybe in Qatar. But if you go up to 2030, it's massive. It's unprecedented to have. According to our internal analysis, we are close to 330 BCM It's half of the current energy market. Then within 4 years, 5 years, you will have this supply worldwide with this flexibility as well to go from a place to another. So quite of a challenge, because on the short term, indeed, you have still those tight fundamentals. You see as well on the European gas market that the consumption for gas-fired power generation increased. You are retiring some plants, some nuclear in some countries, some coal, and even gas to coal was rather dynamics will change over 2025. You had gas which will tend to be much more profitable than coal for producing power. So for this summer, you can have as well new dynamics on the power markets, bigger reliance on gas-fired power generation. And then, obviously, if you want to refill your storages, you need that supply. And when you look at the summer-winter spreads, it seems that the market is not yet comfortable enough to price for very strong storage injections. But as it did last year, probably that with the time going, the market will have a bit more confidence on the ability to refill storages quite high ahead of winter 26, and we will have probably next year nice discussions to see whether this shift on energy markets puts the price dynamic in let's say less volatility. The volatility currently is driven, as we said, by geopolitics, but by true fundamentals. We in Europe are have still quite a tight situation when it comes to storages.
It is indeed quite peculiar, and to a certain extent, this is, from time to time, I joke with a few of the people on the market that we are seeing a full integration between gas and power, also in terms of price spikes, something that was very unusual a few years ago, but since the reserve margins across both markets are getting thinner and thinner, and we're basically running the gas and the power market on very low margins in terms of overcapacity. Then you have these interesting dynamics where the long term obviously looks well supplied, but then in the near term you face all these shortages or sudden imbalances that obviously push prices in one direction or on another. If we move to the power market, Laurent, I think that there is obviously an expectation that 2026 will still have a lot of price spikes, because what we've just said, and there is still quite an imbalance in terms of looking at the different seasons and the contribution of different supply sources. There are a few countries that are still heavily reliant on gas, which they are heavily impacted by these price spikes. But there is also an interesting dynamic that is starting to take shape in terms of the power market. The European power market is interconnected and is kind of integrated, but you see zones that are behaving differently from others. Is 2026 actually the year where we see these happening and taking full form?
It's I just talked about disconnection of time spreads. When it comes to the power prices in Europe, we have a dislocation of prices between geographies. I would say there is France and Spain that are clearly enjoying, in average, the low prices. And when you look at next year, around 50 euros per megawatt hour, and another pack of countries like Germany or the Netherlands, Belgium, and UK, which are rather at 80 or 85, much more reliant both on gas prices and on EUAs. And the price of CO2 went up to 90 euros per ton at the beginning of the year. So really, this dynamic, which reflects as well a fundamental reason, there's a limited level of interconnections between those countries that have constraints. You have a lot of periods in the years where Germany has enjoyed a lot of renewables. So this is very interesting to see that this integration of power markets are still displaying a different landscape. And one of the key elements was demand. During the crisis, the power demand reduces a lot. And we have a small rebound, but I think that it can be, by the way, one of the surprise for 2026 is indeed that the power demand is still growing, probably slower than anticipated some years ago, but still you are adding terawatt hours of demand thanks to data centers, thanks to electrification. And when it comes to the supply, the main source of new supply that can be available and delivered on the market for the coming years is renewables. For nuclear, it will take years, if not decades, to have new capacity. For fossil fuel fire generation, indeed Germany is pushing for a tender for gas fired, but it's quite limited, the fleet, over the short term. So renewables are going to play a role, and we have a lot of regulatory uncertainties on how much capacities will be put on the market. We know that in springtime you will have a lot of negative hours still, because the flexibility that should be brought by batteries, for instance, can be a bit delayed compared to the needs. So it's very interesting to see those different dynamics. And if we take the market views, the market anticipation, it seems that this disconnection between the French power prices and the German one and the Italian one that are even higher, it's here to stay because it will take time to develop interconnections. My only attention point is look at the demand dynamics. When power prices are low, it can boost some use. And finally, this equilibrium might not be that stable. And if you move the needle by a few terawatt hours, you can suddenly recreate a convergence between those markets.
Yeah, and indeed, I think that we are running on a fine equilibrium across different markets at this moment, and yeah, there are signs that things might change, but not yet, if you want. And my last question, you already alluded to it. I did ask you the same question last year. I know it's difficult and we don't have a crystal ball, but what is the surprise of the year for you? What's going to shake markets this year that we cannot really say it now?
Yeah, it's difficult. I think that last year I mentioned the OPEC, but this year I would really, and it's the same in the US markets. The dynamic on the power demand is really interesting because for market analysts, actually it's difficult to catch. The data is not perfect. We have much more decentralized generation that can disturb a bit the signals. And when we run sensitivity with tests with fundamental models, sometimes we can be surprised by the fact that you are on the fine line, and that would be maybe one of the surprises is to see in places like Europe, where sometimes we are a bit probably too pessimistic and tends to keep the past messages. And actually, I would not be surprised that both the European economy and probably the power demand would surprise on the high side. In the US, I would say that it's well. There is a good consensus on the growth on power demand with data centers and AI, but still, in terms of power prices, I would say maybe there is a bit of cautiousness to see indeed if this demand materializes, how the market can react on the upside, and this can be as well a good dynamic when we look at at prices over the long term. And then there will be probably indeed discussion on the competitiveness between Europe and US when it comes to power prices, and what is the strategy? Do we want to add more renewables? Do we want to slow down on renewables? And then I will probably, and without giving you my what can be the surprise for on the geopolitical side, but we all know that we have to look at the White House to discover the new surprise.
Yeah, that's probably the only certainty that we have right now in terms that we know that there will be a lot of surprises coming from the White House. Laurent, thanks a lot again. It's always a pleasure, and it's super fun to have you on and this type of conversations. Let's review the 2026 once we get towards the end and see what we got right and what we got wrong. It's always a useful exercise. And yeah, to the next time.
Yeah, it would be with a great pleasure, Matteo, and thanks again for inviting me. See you soon.
Thanks all, and as always, you can just reach out or obviously look at the previous episodes of the SAS Energy Foresight podcast. To the next one.